He's the India analyst for IT and auto sector from BNP Paribas. To start off with, Kumar, a few days back, BMW has lowered its guidance for 2024, citing concerns from the Chinese market. That has also put pressure on the share prices of Tata Motors, given the fact that China is a key market for them as well. So globally, how are you reading into the auto sales volume? Is it the weakness only in the Chinese market, or is the European market and the US market also showing some signs of weakness?
Hi, good afternoon. Thank you for having me on the show. So the guidance cut by global PA definitely is indicating that there is some moderation in demand environment. We regularly keep tracking the demand trends across different geographies, and after 2 years of consistent growth, now over the last 2 months we have started seeing that YOY growth in the major developed markets has started declining. That being said, if we look at the lateral data points that we constantly track and we think are strong lead indicators for demand, continues to be largely mixed. It's not indicating a sharp deterioration in demand environment. Consumer confidence index in most of the geographies are staying steady. The used car prices in the US surprisingly moved up in the last month. Although incentives and inventory levels definitely have started moving up. And that's why I mentioned that the demand environment appears to be mixed and definitely moderating from the high growth which we had seen over the last 2 years, but so far not indicating that we are heading towards a very sharp moderation in the demand. China, most of the auto companies had already speaking about that they are seeing incremental pressure and demand weakness. The company you spoke about was among the only few who spoke about improvement. And it seems like that there is a convergence in the outlook on the China side, that the demand outlook is definitely not improving in that geography. But thankfully, the dependence on China, at least for profitability, has significantly reduced what it used to be 7, 8 years back. And in that context, the impact of moderation in China may not be as material as it used to be in 2015-16.
Okay, so that's the take coming in. It's not a structural slowdown. Yes, last couple of months have been difficult, but not very broad-based at the moment. Rakesh, hi, Anisha joining in the conversation. I wanted to specifically ask about Tata Motors now, because yesterday the stock was down 6-7%. Heavy discounting has people concerned, high inventory in the system, plus the fact that, of course, there was a guidance cut coming in from BMW. What do you make of this, and what's your recommendation on Tata Motors?
Hi, Anisha. We like Tata Motors, and we think that their FY25 guidance should not be under risk at this stage. They have already given a very conservative guidance, which should be quite achievable. They have spoken about low single-digit revenue growth in this financial year and largely flattish EBIT margin for the JLR business. Looking at how they have been performing in the recent months, while I was speaking about the industry is looking at a decline over the last 2 months, Jaguar Land Rover has been reporting decent growth in the last 2 months, and they have been gaining market share in some of the markets, especially in United Kingdom. And in that context, they seem to be outperforming the industry, at least in the recent few months. And in that context, given their outperformance in the recent months and their guidance being quite conservative, we don't think that there is a material risk to the guidance that they have given. And we continue to like this stock. The risks certainly would start arising from FY26 perspective, how that pans out, but that still is a little far away to take a call so early.
When it comes to the domestic market, there is also a pressure that we are seeing that inventory has built up. So what are your channel checks suggesting? How is the inventory level increase in the domestic market? Also, you must have spoken to multiple dealers. What are they indicating? What is the kind of inquiries that they're seeing ahead of the festive season?
So in the domestic market as well, we had seen a very strong growth period over the last 2-3 years post-COVID. There was a very strong pent-up demand, and that is something which had driven a very strong sales, and the mix also improved in the industry. There was at the same time supply constraints as well, and hence the inventory levels had really gone down. So we are to keep in context that we are coming from an other side of the extreme where the demand was really strong, but the supply was constrained. And usually you would see when the mean reversal happens and things normalize, it typically doesn't stop at the mean to start with. First, it swings on the other side. And that is something which we are currently seeing, that as the production has started improving across OEMs, while demand has moderated, we have seen a swing on the other side where there is an inventory buildup across most of the OEMs. And that has started resulting into some of the discountings also going up. So that is something which we are picking up from our channel checks as well, that the system inventory definitely has gone up. Discounting has gone up. Some of the companies have officially announced price cuts as well, especially in EVs. And that is something which we definitely are catching, that the demand moderation is definitely well underway in India as well. But we wouldn't call out, especially in India, this to be a structural concern from demand perspective. We think this is more of an adjustment of demand supply, which will take a few quarters than to call out as a structural weakness in demand.
Okay, but if you could just give us some details, like is the inventory high when it comes to the commercial vehicle segment? Is the inventory high in the passenger vehicle or in the two-wheeler segment, which is that segment which is seeing most of the inventory pressure coming in?
The passenger vehicle segment definitely has higher inventory levels. Two-wheeler companies have now started building their inventory, but the demand also has been relatively quite strong. So the inventory pressure doesn't appear to be as high as it is for passenger vehicles to start with. Commercial vehicle doesn't have such a large inventory pressure so far, but there is also an expectation of an improvement in second half as the government expenditure starts picking up, and hence the concern over there also is not that high from the inventory perspective.
So that's a view on the channel checks. But Rakesh, what's your top recommendation as far as the sector goes? And I ask you that because within autos, of course, there are various segments. Somebody who has a front foot when it comes to the EVs, the CV, the PV, the two-wheeler plays. What within auto looks interesting to you at this point of time from a risk-reward basis?
Maruti Suzuki is a sector topic from long-term perspective. The stock hasn't done much in the recent months, and the valuations look quite attractive. And the expectations also are quite moderate from the company. And hence, we think that it's a good setup for the company to surprise positively on earnings. And given the valuations are really low relative to its history, there is a potential to see an outperformance from the company. Two-wheeler stocks, we are concerned on the second half when the base starts becoming more tougher for the industry, how the growth will sustain, especially in the context of valuation, how it has stretched. From cyclical perspective, we are more positive on commercial vehicles, especially Ashok Leyland. That is our cyclical pick, where we think that we believe that heavy commercial vehicle segment likely has entered into a next upcycle, and Ashok Leyland should be a key beneficiary.
Thank you, sir, for joining us and giving us all those details and for putting things into perspective. Well, with that,
if you like this video, then like, share and subscribe to ET Now.